the desire to build something that is long-term valuable, that is, in 10 years going to be doing something sensible and useful for the world. It's just not there. There's just no need. Why bother when you can sell it to people that are ultimately going to buy it so that they can sell it on to essentially other people, more people, and do their job in hyping it? Well, quite possibly. I mean, it's a theory, right? I don't have the economic data there to back this up, but it is my theory that this is actually what is, to a large extent, polluting the markets, and why we are seeing huge amounts of money go behind L1s that, if we're honest, probably don't have that much of a future.
The content presented on this podcast does not in any way represent investment advice. The information is provided for educational and entertainment purposes. Crypto assets are considered risky investments. You should always do your own research before investing. The opinions expressed here do not represent those of CoinDesk's editorial staff.
Hello, this is Tom Farley, CEO of Bullish. Bullish's flagship media business is CoinDesk, and welcome to the second installment of CoinDesk Spotlight, our podcast. And I'm excited to say that we have Gavin Wood with us here today. I have had the privilege and the honor in my career of interviewing many really impressive people. And yet, as I told Gavin prior to taping, I found myself not just excited this morning, but flat out nervous because I've never met Gavin before. But I am a fan, and I'm appreciative of everything he has done for the digital asset space. Doesn't need an introduction, but founder of Ethereum, founder of Polkadot via his role as CEO of Parity, up to some really cool things now. This is someone, as much as anyone, has helped give us an underpinning as an industry. And I'm excited to hear what he has to say on sort of crypto, digital assets writ large, as well as the state of blockchain technology, and myriad other subjects that I hope will come up here in the podcast. Gavin, thank you so much for joining us here.
Thanks for having me, Tom.
So I want to, I have so much I want to talk about, but why don't I give you the floor first to just let our listeners in on what are you up to today? So we know about your Ethereum history and certainly your history starting Polkadot, but many of the listeners may not be aware of exactly what you're up to at this moment.
Right now I'm doing, most of my time is being dedicated to continuing to develop and finalize the next iteration of the Polkadot protocol, JAM, as it's been called. And with the time that I have remaining, which isn't all that much, I've been also thinking quite a lot about the civil resistance problem that we have in the Web3 industry as a whole.
So tell us a little more about JAM. I read the gray paper. Nobody has accused me of being the Albert Einstein of blockchain technology. I didn't understand it entirely, but it sounded to me like the next iteration of Polkadot, as you just described, but using some of the precepts and concepts, not only of Polkadot, but also of Ethereum, as well as some new ideas that you've originated for this JAM project.
Yeah, it is indeed a sort of, in some sense, a hybrid protocol. Whereas we see with Ethereum, it's very much a smart contract blockchain. And we see with Polkadot, it's a blockchain designed first and foremost to secure other blockchains. JAM uses some of the underlying fairly sophisticated crypto economic mechanisms of Polkadot, but it does so in order to provide a more general, if you like, a little bit more like a smart contract environment. It's not quite a smart contract environment for a few reasons that I could go into. So I don't really want to call it a smart contract chain. It's still perfectly capable of doing the same things that Polkadot does, which is to say securing blockchains, but it's also capable of doing quite a lot more. And this generalization and this ability to utilize Polkadot's underlying apparatus for doing these general tasks is really the point of having Jam.
Can I almost think of Jam as a layer 2 or 1.5 perhaps on Polkadot? You know, in other words, as I was going through the great paper, I found in some ways, you know, part of parachains was one of the innovations of Polkadot that I found interesting. Many people found interesting, and part of Jam, it felt to me was allowing parachains, but then also creating a way to bring it back together where you don't lose some of the disadvantages you got by creating them in the first place. Can I think of that simplistically as almost a layer 2, or maybe it's a layer 1.5?
Yeah, I mean the layers get a really odd when you know, with Polkadot.
Well, yeah, I mean, I struggle with the layers. Like, I hesitated to even say that because Polkadot, I've heard you talk about as a layer 0, and candidly, I'm not even sure what a layer 0 is.
So it's like we the layer 0 kind of came from this idea that, well, if blockchains, if like underlying smart contract blockchains are going to be layer 1, you know, like Ethereum, then if Polkadot is securing these chains,
right?
So it's a blockchain that they rest upon, then it's kind of be the layer below, right? Kind of layer 0. Then.
Right.
But if we renormalize everything so that actually Polkadot as the blockchain, as the thing that is securing blockchains, if that's layer 1, then Jam in some sense sits below it, because Jam is hosting the service on which that secures these blockchains, that secures them. So Jam is still kind of below the blockchain, but Jam can host things other than blockchains. It can host things other than the apparatus for securing blockchains, I should really say. So Jam, if we're going to say Jam is layer 1, then we're going to say that the smart contracts are the thing, or not the smart contracts per se, but the services that sit on Jam are going to be kind of sitting on the layer 1. We'll call them for the moment layer 1 services. Then blockchains that are like parachains that are going to be secured by this blockchain securing service, this layer 1 service. Well, they will become layer 2s. So I suppose in some sense, what Polkadot is currently doing would become a sort of layer 1.5, if you like, on Jam.
It's not, on top of Jam.
It's not Jam itself, because Jam can do something even more general, but it's something that sits on Jam. So if we call smart contracts that sit on Ethereum layer 1.5, then we call these services that sit on Jam layer 1.5 as well, and then we call the parachains themselves maybe layer 2. So if you want to think about it in terms of layers, that's how.
No, that was very helpful. I wish we had this conversation before I read the great paper. And where are you in terms of the birth of Jam?
Well, the grey paper is currently version 0.3.4, so it's maybe getting towards half of the way from the original draft at 0.1 to a 1.0. And 1.0 where it would have to be at for us to launch the protocol. Roughly, I'm still aiming for for the same kind of timeline as with the yellow paper. So the yellow paper was launched April 2014. With Ethereum network, the final network launched around, I think, July 2015. So grey paper was initially launched 2024, April. So again, hopefully it's going to be, roughly speaking, next summer when the Jam protocol is launched. But of course, it's software development and it's protocol development, and that's which inevitably makes things rather uncertain. So, it's a target date. It's not a contract.
I'm very familiar, and I can hear toddlers in the background, and they will push out the date of software development. No question about that. So, I think childcare might end up being your biggest challenge to getting all the code written.
And a challenge it is.
So, Gav, I like to pretend that, you know, I'm a digital assets native. Been floating around for a while, but I can't shake my TradFi roots. And I look a lot at analogs and parallels with the couple decades I spent in TradFi, and I try to apply it with digital assets. And when it comes to layer ones, I look around and I listen to the debate. And as I said, I don't understand all the ins and outs. I wish I did. But there's several dozen layer ones that have committed developer communities. Mm-hmm. And when I listen to the advantages or the disadvantages of the various layer ones, I mean, Ethereum was first, and Solana's cheap and scalable. Tron is cheap, and we could go through many of them. Mm-hmm. I wonder, the most vital resource. This is my view. The most vital resource are the developers actually building cool stuff on these blockchains. And my question for you is, are we at a point right now where there's negative utility because of the number of layer ones? And we can get into why that is, why they're still being funded, new ones, why the developer communities are so locked in, and I have questions about that as well. But are there just too many? And if so, what, if you had to kind of look into your crystal ball, what is the right number? And this is where I look at TradFi. How many futures exchanges did the world need? Or even just how many picture sharing apps on social media does the world need? Or how many backbones for the internet does the world need? How many layer ones do you suspect we ultimately need here? And how do you think the wheat separates from the chaff? Is it really the specifications of these layer ones? You know, this degree of centralization versus that, the block size of this versus that, the security of this versus that. Is it that, or will it ultimately be something else that will allow the non-Ethereum winners to emerge?
Well, firstly, I'd say that Ethereum, and for that matter, quite possibly Bitcoin, are no, in my mind, not really an obvious exception to any rule, whatever that rule might be, for deciding, which blockchains will ultimately survive. Bitcoin might be an outlier here simply because it was the first, and it is first and foremost not a blockchain technology, but a cryptocurrency. It's a cryptocurrency that's backed by blockchain technology, but I wouldn't say that Bitcoin developers have any desire to take this as a technology much farther than Satoshi originally deployed it. Mm-hmm. I would say that
and maybe not even as far as Satoshi imagined it, meaning a method for payment. It feels more like a method for ultimate store value, although perhaps that could become a method for payment in the future. But take your point.
Yeah, indeed. It feels very much like it's more of a buy-in. It draws most of its value from the fact that it is A, constrained by consensus, and B, that enough people have already bought in, or enough value, which in some sense could be measured by people, have bought in to these constraints. It's not about giving a service, right? The constraints, in some sense, are the service.
Right.
The constraints, and for that matter, the fact that enough people have already bought into these constraints, or this instance of these constraints. Anyway, so I think Bitcoin might possibly be an outlier. I don't think anything else is particularly an outlier. I don't think people have particularly bought into the set of constraints that Ethereum layer 1 has provided in any particularly reversible way. I think Ethereum still prides itself and competes primarily on its technology base, on the service that it strives to deliver, which is a smart contract platform. And in that sense, I think that, and maybe you could also argue as a community. I think Ethereum derives a lot of its value from the fact that a lot of people identify with Ethereum, even if they don't strictly utilize the Ethereum service. But community is not sticky particularly. It's not sticky in the same sense that a financial buy-in is sticky. Okay, so what do I think layer ones are going to compete on? Essentially, it's going to be on partly community and partly service offering. And I think that in terms of service offering, it's not it's not about incremental improvements, right? It's not. This is why I didn't try and make Polkadot to be an incrementally improved version of Ethereum. I don't think it's sensible. I don't think it's helpful. And with Polkadot, it was really about trying to make something different, and for that matter, also push the envelope of technology, a degree further. With Jam, it's about largely doing the same. Now, why do I think that sort of moving things a little bit more in terms of this permissionless code deployment, this kind of smart contract-esque model is going to take me a bit further to this? Well, it's because that utilizing the technology that Polkadot has developed, what I've loosely called cynical rollups, with a few other technological advancements that are all detailed in the Jam grey paper, we can make something that is categorically better than a smart contract platform. We can make something that essentially allows developers to deploy code that is not identifiably smart contract code that is, we would normally think of as code that just gets deployed on a regular computer. But still host that code on a blockchain with all of blockchain's trustless guarantees, right? A trustless, permissionless, global, ubiquitous environment in which we can host things like financial applications, voting applications, governance applications where the actors, the players within these applications don't trust each other, yet they still handle huge amounts of value. But we can, as I say, do so using software that is meant for regular machines, not having to deal with gas, not having to deal with blocks, not having to deal with limits in terms of auctions and gas price stuff and all that. And this, I think, is a categorical improvement from the blockchain model. From the smart contract model.
One thing you said, communities are not sticky. It feels like in digital assets, communities are almost irrationally sticky. In other words, if you look at the developer communities on the layer ones, they might as well be marching around with Solana flags, and it's very tribal, and part of that, I think, is the code lock-in. You've got some are on Solidity, and then Rust and C++ and C# and Python and codes I've never even heard of. But you think that's right? That just to test that a little bit, that communities aren't sticky?
Yeah, I mean, I think that there are inevitably going to be people within communities who are extremely sticky, the flag carriers, right? But does this apply to the communities of individuals that are valuable, right? Flag waivers have limited value, I would argue. The kinds of, as you were mentioning earlier, the kinds of individuals that are valuable to have in a community are those with the clear mindset that are really developer and innovation oriented. The ones that are not there out of simply loyalty to some arbitrary icon, but rather who are there because they legitimately believe and are able to give and receive value from this particular service, this particular set of constraints. So, Ethereum, the Ethereum community is valuable not because there's a lot of flag waivers there. And I think if you actually talk within the Ethereum community, you go to I was at where was I at? EthCC, I think it was in Brussels this year. I might be getting EdCon and HCC mixed up, but the one that was in Brussels a month ago. And I was chatting to people, and I was also in another East Prague event, also
with
chatting to
Vitalik.
people.
Yeah.
That's right, with Vitalik. Yeah. And the people I were chatting to, these were not like ETH flag wavers. These were not people that would like, I will die on a hillside if I can, to stay in my ecosystem. Right? People who are interested in the technology, and they went to the Ethereum community for its technology, for its luminaries, for its vibrant debate, but not because they were somehow sticky to Ethereum. If they found those three things in another community, they would move to the other community in a flash. They're there because Ethereum is doing its job right. They're not there because it's because they are married to an icon. Now, I do agree that there are some people that are married to the maximalists, we would call them, right? But they are not necessarily. You don't want an ecosystem, not particularly, unless you're building a religion. You don't particularly want an ecosystem full of maximalists. If you're aiming to deliver useful change, you don't want the maximalists. You want the innovators. You want the people that are willing to think differently and approach problems differently and actually develop without being constrained to a particular mindset.
So I like this framework a lot. So to restate it in my, what's the explain it to me like I'm five, to quote The Office. If you build a better layer one, you're going to attract developers, even if they have to come from a different layer one, even if they have to learn a new language. If it's good enough, in other words, as you said earlier, it can't be incremental. There has to be a step function improvement. And if it's good enough, you're going to draw a community. Okay. Let's stipulate that that's accurate. Makes sense to me. On the other hand, I suspect you and I will both agree 30 plus layer ones with developer communities, pretty big number. And what we really want to see increasingly in the digital asset space in the next 10 years are more and more use cases, likely programmable finance type use cases. These are my words, not yours. Feel free to push back. Benefiting from secure, transparent blockchain transactions that involve lots and lots of users who are not developers. And if you have 30 blockchains, by definition, you're going to have very different user experiences for those users. And it's going to be confusing, and it's going to constrain adoption. Again, these are my words. I'm not summarizing what you said. It's going to constrain adoption. And I'm no ETH maxi. I mean, you look at the layer two on ETH, the user experiences are terrible for many of them. So I don't think the problem's solved over on ETH. But if we're going to require those use cases, and this one's here and this one's there, and you got to do this and that, I think it's going to get in the way, and it's going to frustrate the growth of this industry. I think in a perfect world, we would see a quick consolidation to a very, very small number of successful layer ones. Very small. Think futures industry, pictures on the internet, settling trades, clearing trades. You're talking 1 or 2 or 3, like those sorts of numbers, to spur adoption and make it easier for many, many people all around the world to benefit from these technological advancements. Can you react to that? I know I'm on my soapbox a little bit, but I'm just curious if we agree or disagree broadly.
Well, consolidation's an interesting thing. And indeed, at some level, it makes sense. So this is one of the reasons why an idea within Polkadot, Plaza, which is roughly speaking, attempting to bring a single point of meeting that is of smart contract meeting, sort of a single smart contract or a single default smart contract environment within the Polkadot ecosystem that supports EVM Solidity and EVM by code, by design, is gaining some traction. And I mean, it's why I think it's a sensible idea, and there are others in the Polkadot ecosystem as well that also think it's sensible. Many others. consolidation that doesn't come with significant technological trade-offs, but yet still provides provides the means of avoiding skills, people that already have skills to have to reskill, like avoids the need for reskilling is sensible. Like, it just makes sense. From a business perspective, from an economic perspective, it makes sense. Now, whether it makes sense similarly to say, let's have just a couple of tokens in the world, is I would say, a very different argument, because it's sort of like saying, let's take the stock market as it stands, like the FTSE 100 or the S&P 500, right? And just say, let's consolidate it down to a single set of ratios based on market caps today, and just say you can only trade in 3 different, groups of companies, and just say, look, we have the technological groups of companies, Google, Microsoft, Apple, all the rest of it, right? Let's just fix their market caps and say, right, that's it, we're done. We don't foresee any more significant innovation within these companies. Let's just consider them the establishment and say, if you want to buy technological stock, you buy this ratio of stocks, this tracker, if you like. If you want to buy, banking stocks, you buy this banking tracker. If you want to buy insurance stocks, you buy this insurance tracker. That would make it so much easier for investors. At the cost of totally wiping out the possibility that Microsoft could do significantly better than Apple in terms of innovation, out-innovating them in AI, for example. Is it a good idea? Well, I think we both agree, no, it's a really bad idea. It would make the lives of investors, particularly things like pension fund investors that tend to not want to look very deeply into, individual companies' strategic value over the next 25 years. They want to just go into, just assume that the market will figure that out and just go into minimum risk indexes. It would make these kinds of companies, these kinds of investment scenarios much easier. With blockchain, unfortunately, we are still doing significant innovation, and therefore sort of imagining it as a sort of, you can, I don't doubt that you can say, well, look, there's of these 30 L1s, maybe 20 are not doing particularly significant innovation. We're talking about incremental optimizations or specific trade-offs between, say, centralization and performance that they are making, and it's just a slightly different trade-off on the spectrum, right? Is it useful to have all of these indefinitely? No, probably not. Probably we are going to coalesce around very particular trade-offs. But if we're talking about doing significant innovation, then I think it's a little different. And I think the market does need to be able to have separate, let's say, investment possibilities, separate stakeholding possibilities in protocols that are legitimately trying to provide the next step of revolutionary levels of innovation.
I loved everything about that answer, and I agree. And I know it sounds a little odd. On the one hand, I just think there's too many layer ones, and I do think it hurts the growth of our industry. On the other hand, I'm a free markets guy, and to the extent the market wants to fund the 33rd layer one with $500 million at some high valuation, why get in the way of that? And so it gets me thinking about this, because look, and I sound like a sycophant here, but there's one Gavin Wood. And you rock up and you go into, some investment house and you say, I'm going to start a new layer one. And I genuinely think we can emerge the number 1 or number 2 guy. That's $1 trillion idea. Now, very small probability you get there, but you could get there. So I can understand that getting funded. But it takes me to, why are so many of these getting funded? And it feels to me like the net present value of the future cash flows of these new layer ones can't be north of 0. But yet they're getting funded. And I wonder if that's going to cool down, because we've had this, hey, we got this new layer one, and we're going to put 3% of the token out for trading, and it starts with a real high value, and people get excited about it, and so the initial investors say, well, we're going to get a big pop on the token, and they're not doing the traditional evaluation of, can this thing actually change the friggin' world, which is really what you need to say, because it's going to be hard to unseat Ethereum. It's going to be hard to unseat Bitcoin, and it's even going to be a little bit hard to unseat Solana. So I don't know. I think there's some structural issues, but I'm hopeful the pendulum is swinging back, where you're really only going to see excellent, rational business ideas get funded in that way.
Yeah, I don't know. I hope I would share your hope. I'm not sure I'm very optimistic about the possibility. But I think the unfortunate realization for me was that what tokens are doing is not just providing what we said back in 2014, a means of avoiding transaction spam, right? Required crypto economic means of avoiding transaction spam. What they're doing is providing a means of allowing people to bet with high stakes. It's unfortunate, but I mean, in my mind, it's unfortunate because it massively pollutes the markets, and turns them into essentially speculative instruments for speculation, right? But instruments for basically betting. And as you said, this then pollutes the underlying founding capital and the theory behind the underlying founding capital, not from can we ultimately sell what we are founding to sensible people, to people who are going to look deeply into whether this is giving value to society in a sort of, not that I think IPOs are an especially good model for this, but they're better than a lot of the stuff. They're better than trading on a consumer exchange, right? On a consumer exchange, there's a lot of dumb money, and there's a lot of dumb money that wants to buy into specifically the thing that they can sell. They can flip, who knows, an hour, a day, a month later for a profit. And this is basically about judging how many other people are going to buy it before I sell. Where am I on the wave? And there's an assumption that it is a wave. There's an assumption that it is going to follow a bubble. And there is no desire to build, with a lot of these things, the desire to build something that is long-term valuable, that is, in 10 years going to be doing something sensible and useful for the world. It's just not there. There's just no need. Why bother when you can sell it to people that are ultimately going to buy it so that they can sell it on to essentially other people, more people, and do their job in hyping it. The model of delivering something significantly valuable in 10 years' time is just not there. And as such, we end up with this, well, quite possibly, it's a theory, right? I don't have the economic data there to back this up, but it is my theory that this is actually what is, to a large extent, polluting the markets, and why we are seeing huge amounts of money go behind L1s that, if we're honest, probably don't have that much of a future.
Thank you. Very insightful. I want to get to two other topics here. I honestly could go on for hours on this, but we want to have a nice, tidy podcast. I heard a quote from you that I thought was fascinating. And again, injecting my bias into this podcast, and I hope it's okay. I look at digital assets and I say, okay, clearly Bitcoin, runaway, smashing success. US dollar stablecoins in particular, smashing success, in particular, use for payment and store value for people in non-USD countries. And then the third big bucket is DeFi, for me, to keep an eye on. The growth of DeFi. Why? Because the promise of digital assets, in my view, is secure and transparent programmable finance, taking out layers, making the world more efficient, allowing people who were heretofore maybe had less access or sophistication access to sophisticated tools. And I think DeFi is a way to do it. One thing that you said about DeFi really captured my attention. I have a couple questions about it. You said DeFi needs to be, or will need to be in the relatively near future, I don't remember your exact quote, either entirely deregulated. In other words, the D has to be real, or it will be, and this is a quote, smothered by regulation. What do you mean by deregulated? Sorry, I said deregulated both times. Decentralized. Has to be entirely decentralized, or it will be, quote, smothered by regulation. What do you mean by decentralized in that respect? And incidentally, I agree with you 100% on that. But I don't know exactly what you mean on decentralization.
Made resilient is essentially what I mean, which is to say, the reason that Bitcoin is here and e-gold isn't is because it was actually decentralized. It was resilient. It could not be shut down. Right? It was beyond the means of regulators to shut it down. At least not without significantly impact, or potentially significantly inviting significant impact from the judicial branch of government. Like, the judicial branch of government could very easily find that regulators are overstepping their powers by attempting to shut down something which, at the end of the day, revolved merely around communications. Now, that's not an issue in countries like Russia and China, right? Where the judicial branch of government is controlled by the executive. The executive doesn't want it there. And the judicial isn't going to go against them. But it is a problem in free countries, right? In the Western world. So I think DeFi is going to follow the same trajectory. It's not going to be, and I think for what it's worth, layer ones will form the same trajectory as well. It will take some time, and with potential political changes coming into the US in November, it may be not the US that leads this, but the EU is pretty hardcore on its regulatory ambitions, the FATF isn't going to go away even with political changes in the US. I think we will see a tightening regulatory environment that blockchains and the blockchain hosted services will come under, and that decentralization in name only is not going to cut it indefinitely. I'm willing to keep my eye. I think the situation is fluid. I don't think that I can say with certainty that decentralization isn't going to, as a requirement, isn't going to, magically evaporate in 10 years' time due to, political changes in the world. But I think from what I can see at the moment, it's not going away. It's only going to get tighter. And DeFi, many DeFi protocols flagrantly disregard regulatory requirements in many parts of the world. And the people behind them are probably going to start having their doors knocked on if they're not careful to ensure that they are 100% out of the loop in terms of the command and control of those protocols. And when we see multi-sigs of like 5-7 people that are essentially in charge of protocols, I'm thinking bridges in particular, but there are many other DeFi protocols there that have governance structures that have a Satoshi coefficient, a Nakamoto coefficient of in the realm of a few to several, that are often the founders of the network or the major investors of the network. Regulators are not dumb. They're going to get wise, and they're going to come after the people that are in control of a network that is doing things that they don't want them to do.
That is the exact example we at Bullish, on the Bullish side, spend the most time kind of wrestling with. We have a venture capital arm. My colleague Alistair Foster runs for us, and we believe in DeFi, in decentralized programmable finance. And so many of the most interesting examples are exactly what you just described, where three investors and three founders control, I'll make it up, 75% of the tokens. And yet the line is, well, yes, we're operating a financial application that's dealing with money. We don't do any KYC or AML, any, in the year 2024, because we can't possibly. The code just exists in the ether, and we don't have keys to it. The only way you could ever make a change is if a majority of the tokens agreed to make a change. Like, I know I'm granddad. People look at me like I'm crazy. Oh, here comes the New York Stock Exchange. This guy loves centralized government. He'll never understand crypto. Yeah, but I think I'm a realist. We just, in the year 2024, that doesn't feel like it's going to fly to me. And that's why I asked the question. I think fast forwarding 5 years, DeFi will be a real thing. And like you said, it'll be truly decentralized and resilient, or it'll be less so. And users will need the KYC, AML, in order to have access to a smart contract. It'll be one of those two, or something of, some hybrid. Does that seem reasonable to you?
Yeah. And, just to, add a tiny little point onto that, I've been talking quite in the last year or so about, Web3 ideals, and top of the list is resilience, right? This is why Bitcoin's around. It's a resilient protocol. It's hard to shut down, right? It's hard to corrupt. If DeFi is not, resilience means resilience, not just against perceived enemies of the protocol, perceived malicious nodes, malicious individuals, attackers. It's resilient against founders as well. It's resilient against investors. It's resilient against token holders. It has to be resilient against everyone, not just the presumed malicious people, malicious nodes. It has to be, if it's not resilient against everyone, it's not resilient, period.
Right.
Yeah, resilience isn't selective.
Right. Awesome. I want to hit one more topic, which is for those of our listeners who think to themselves, wow, Gavin knows a lot. How can I know a lot? What do you do in your spare time? Well, let me ask it two different ways. And I hear the kids in the background, so I think I know the answer. What do you do in your spare time when you're not doing anything to do with crypto? Mm-hmm. Number two, how do you stay current on what's going on in the digital assets, blockchain, crypto industry? What news are you taking in? How do you do sort of self-development to make sure you stay on top of your game?
All right, first question. Mostly these days, music. So I've been dabbling in, messing around with the guitar and keyboard, like piano and stuff. But more is kind of reconstruction of music, deconstruction, reconstruction. So DJing in some sense, but it's sort of next level DJing with AI. The whole concept of DJing is totally rewritten. We're no longer trying to simulate vinyl, record players using CDs and MP3s. We are moving into essentially able to re-engineer tracks from their component, deconstruct and reconstruct multiple tracks in different ways, using kind of like pulling apart the Lego figure and combining the head from this one with the body from that one with the legs from this one. It's a mad new concept, but it's AI has just unlocked it in the last year or so, and we're seeing some really interesting apps that are doing it. So I'm kind of like moving.
For the listeners who may not otherwise be aware or already intimidated by Gavin's technical chops, he has a PhD in music visualization. So when he says he's involved in music in a different way than we are. But carry on.
But yeah, I mean, even since my teenage years, I've always loved like listening to music. I never got deeply into playing a musical instrument, but I was composing music when I was on my Amiga 500 sound tracker stuff, like, it's age old stuff now, but it's, I always enjoyed sort of the creation of music, even if not the performance. And these days the tooling's just improved,
Right.
to a different level of magnitude, right? So I'm really enjoying this. So that's where I'm spending most of my spare time. In terms of keeping up to date, I don't read that much. I don't keep too much up to date with the what's going on in the industry. I kind of loosely I'm fed news through, the occasional forums and some of the sort of people that I'm in touch with, mostly the Web3 Foundation researchers. But I do read the Polkadot, like what's happened in the Polkadot ecosystem, the weekly digest. I do look at some of the talks that are happening when I go to ecosystem conferences and wider industry conferences like the Ethereum conferences. But probably more than this, I find that reading just general news is useful. So I've got a subscription to The Economist, and I sort of keep, I probably spend, I don't know, half an hour to an hour every day reading the news, and particularly looking at it from sort of macro trends, what countries are doing in terms of technology, what they're doing in terms of managing changes in the sort of socio-technological environment, how governments are responding to these changes for things like, the mobile phones. Like, we all have a mobile phone now. We all have apps that allow us to do all sorts of things that were just unthinkable 20 years ago, even 15 years ago. How are governments responding to that? How are governments responding to censorship? How are they responding to privacy? How are they responding to personal self-sovereignty? How are they responding to the lowering barriers between jurisdictions? It used to be that if you did an action, it had a jurisdiction that was attached to it. You did an action in the US, you did an action in the UK, you did an action in China. That's increasingly being blurred. How are governments responding to this? What are new trends in terms of the usages of technology? And this is all very important, I would say, reading from someone that wants to create technology that is relevant for the world in the next 5 years and the next 10 years. It's important to know what's happening, where the world is going in that macro trend, and also in terms of the macroeconomic, macro-political sort of global levels. How close are we to some significant global disruption, right? How stable is the world? How stable is the political system that we are living in, and how the political systems are interlocking? For someone that is making technology that is deployed globally, as a global footprint that is relevant globally, what is the global environment? How are the individual jurisdictions able to how are they managing to interact with each other? Are we at a market level of interaction, or are we moving into a more conflict level of interaction? And to what degree can technology aid, hopefully in the case of consensus technology, Web3, blockchain, or hinder a peaceful coexistence between jurisdictions? And at what level does it become sensible for technologies like blockchain to start thinking about creating so-called network states, or state, sort of alternative governance mechanisms for individuals to project their sort of collective spirit beyond nation states?
Closing question for you. This is for the kids. I want to know the personal side. You and Vitalik were a super team, and then went your separate ways. It's like, WWE wrestling. You were Hulk Hogan and Andre the Giant, and all of a sudden, WrestleMania 3, if I have my references right, now you're kind of going against each other with Polkadot and Ethereum. And I'm sure there was some bad blood just in the sense of competitiveness. I watched the ETH Prague conference, and I was trying to detect. I was using my training to try to detect what kind of vibe there was there, and I couldn't figure it out. It looked like you guys are getting along fine. How do you guys get along now, a decade on or whatever it is, having gone through everything you went through? Are you guys friends? Do you guys talk?
Yeah, I mean, as you saw, we talked. I mean, do we talk deeply about our work? No, not particularly. We're both fairly involved in our ecosystems, and to a large extent, our learned interactions come through publications and public speaking. I keep an eye on what Vitalik's saying, and at least in terms of my Ethereum speaking engagements, I can see Vitalik is keeping an ear open for what I'm saying. There wasn't particularly bad blood. For a while after my leaving of the Ethereum Foundation, Parity was still core back in the day. We're still working on Ethereum technology, and we had Vitalik as our official advisor for some years anyway. And for one of the first Polkadot retreats, Vitalik, back in 2018, Vitalik was present at the retreat. And for one of the first Ethereum 2 retreats, me and a number of Parity people were present there. So there wasn't really any bad blood from even from the creation of Polkadot. And the Polkadot from the early stage wanted to be an Ethereum competitor. I mean, as I said before, the point of creating Polkadot, I was very, very careful not to try to create an incremental improvement on Ethereum. I wanted to do something different, and specifically, I didn't want it to involve any kind of significant competition. I wanted to create a separate community, but that had aligned values, so that people didn't feel the need to be in either Polkadot or the Ethereum community, that there were two separate tools for two separate jobs. And I still broadly want to sort of keep that, and to the degree I want Jam and Polkadot broadly to be a sort of a protocol that works well with Ethereum. Now I'm not foolhardy sort of a full sort of teenager in love or anything, and I don't think that there isn't going to be competition there, but there are inevitably going to be maximalists, and there are inevitably going to be people that love the iconography and love and treat these sort of things as kind of religious groups that you can only be in exclusively. But that's not what I buy into, and it's not what I don't want to deny these people a home, but I'm also not going to push that element of it any more than I can avoid. I really want to build. I'm an academic at heart. My first calling was doing a PhD, and I still in how I operate. It's about providing understanding to the world as much, if not more, than it is about anything else in blockchain. What drives me is curiosity, and this is the same within the Ethereum community. So I'm kind of pretty happy in floating between the two. And I think, I don't want to speak on Vitalik's behalf, but looking at Vitalik and looking at the sort of things that he's been saying recently, I think he's kind of in the same camp. He's here not because he owes a desperate duty to the Ethereum investors, in theory, ETH token holders. I think he's in large part here because he's curious, and he thinks that what he's doing is valuable for the world, and it's the same reason I'm there. And so in that sense, we do get along fairly well, and we have a platform, a shared platform that we can talk about and cooperate on.
Great stuff, Gavin Wood. Let's leave it there. Gavin Wood, one of the founders of really two successful layer one blockchains, former CEO of Parity, and currently building his third mega blockchain project, Jam. Thank you for dialing in. We hear the young kids running around. Make sure you're getting sleep in addition to your music hobby and your great work on behalf of the industry. Thank you so much, and let's talk soon.
Will do. Let's indeed talk soon again, Tom. It was a pleasure.